So how do you guarantee you will get approved for any loan? Bruh, just be rich. You are absolutely correct. I would have also accepted don't be poor. I'm kidding, of course. The real question is, what is it about being rich that causes lenders to say, I got you, I'll let you borrow some money, bro? Let's dive into one aspect of being rich that makes it appealing to lenders and how normal people can use that to their advantage to get approved when looking for a house. Imagine two people with the same monthly obligation, $1,250 a month, covering rent, credit card payments, student loans, child support, alimony. Person A earns $2,500 a month and person B earns $5,000 a month. If we know nothing else about them, just that, who can we guess is going to have an easier time making payments on time? The way the lenders do it is they use math. We can use subtraction. We can subtract how much they owe from how much they earn. In the case of person A, he earns $2,500, and if we were to take away $1,250 in monthly obligations, he's left with $1,250 at the end of every month. Person B is left with $3,750. Person B seems safer, right? But what if we introduce one more person? Person C earns $100,000 every month, but owes $95,000 every month. Using subtraction, person B has $3,750 left, and person C has $5,000 left. Person C seems safer because they have more money left over, but there's a catch. If person C loses their job, they still had to pay their $95,000 debt obligation every month, despite having no income. In contrast, if person B loses their job, they only had to pay $1,250 every month. Here's the key: the higher your debt payments are, the more savings you need to have to pay it off. For person C, it takes 19 months of savings to pay off 1 month of debt. However, person B only requires 10 days of savings to pay off 1 month of debt if he loses his job. Subtraction doesn't consider this vulnerability, which is why lenders don't use it. To get around this problem, they use division to figure out who's in better financial shape. Person A has a debt-to-income ratio, or DTI, of 50% versus person B, who has a DTI of 25%. Person B seems safer. Person C has a DTI of 95%. They're in even worse condition than person A. This is called debt-to-income ratio, or DTI. Now let's explore some practical ways to improve your DTI, a key factor in getting your loans approved. One is increase income. Let's go back to person A earning $2,500 a month. Their DTI is 50%. This means half of their income goes towards debt. By finding ways to earn more, like increasing their monthly income to $3,000, their DTI drops to 41.7%. If they reach $3,500 a month, their DTI drops to 35.7%. Increasing the income, the lower number, lowers DTI. Another strategy is to decrease debt payments. For example, let's say person A owns $450 a month on their car for the next 42 months, or about $19,350. Instead, they get a new loan for the same amount, $19,350, pay off the loan with that new loan, and then repay the new loan over the next 10 years. That would reduce their monthly payments to about $290 a month. Now their new DTI is 43.6%. We can see that by lowering the top number, it also results in a lower DTI. Called restructuring or consolidating debt, you can lower how much you pay towards your debt each month. And I made this free calculator so you can check your DTI. Restructuring your debt, just like the rich, helps you qualify for bigger loans and stop being a renter sooner. In conclusion, it's not just about waiting for interest rates to fall. Smart strategies like restructuring or consolidating your debt can help you crack that financial puzzle and get approved for that loan.